Marriott Solutions, Inc. issued 10% bonds dated January 1st with a face amount of $320 million on January 1st, 2018 for $283,294,720. The first sentence says, the face amount of the bonds are $320 million. But the cash they received from issuing these bonds was $283,294,720. After 10 years, the issuer, Marriott Solutions, has to pay back its investors $320 million. The bonds mature on December 31st, 2027, 10 years. For bonds of similar risk and maturity, the market yield is 12%. Interest is paid semi-annually on June 30th and December 31st. Requirement is complete the table below to calculate the amount related to the bonds that Marriott would report in its financial statements. Indicate the amounts reported on the financial statements below for the year ending December 31st, 2018. The first requirement to prepare partial amortization table. Carrying value is the outstanding balance. Day one, when they issue the bonds, the outstanding balance of this debt is the cash they receive, the price of the bonds. So we enter $283,294,720. 6 months later, they will pay interest. Interest is paid on face value and the stated rate. 10% is annual rate, so we have the 10%, it becomes 5%. 5% multiplied by face value, $320 million. So 6 months of interest is $16 million. Interest expense is based on carrying value or outstanding balance, and is also based on effective interest rate. In the market, effective interest rate is 12% annually. But here, be careful, we are calculating 6 months of interest. So half of the 12% is 6%. Multiplied by previous balance, 283,294,720. Connect assets to round to the to report to the whole dollar. So here we will not round up. This is only 2. So 16997683. Then the discount will be the difference between cash paid and the effective interest. Connect automatically calculate for us. And then the new outstanding balance will be previous balance plus the discount being amortized. Why should we plus the discount being amortized? Because the bonds were issued at discount. The face amount is $320 million, but they only received $283 million. The difference is discount. So ultimately, this amount will grow to $320 million after 10 years. They are going to pay investors $320 million. So we should add discount being amortized every period. Okay, and the next period, December 31st, 2018, they need to accrue interest. The interest will be based on effective interest rate, 6% for 6 months, multiplied by previous outstanding balance. Previous outstanding balance is 284,292,403. So the difference between cash interest and bonding effective interest is the discount being amortized. The Connect automatically calculate for us, and then we will add this difference to previous balance to come up with the new outstanding balance. The next requirement asks us to see how the amortization table affects the financial statements. On the balance sheet as of December 31st, 2018, the liability related to this bond is the outstanding balance. So December 31st, 2018, the company will report the liability related to this bonds $285,349,947. Okay. And then on the income statement, interest expense is the effective interest column. For 2018, there were 2 effective interests. Adding them up, the Connect already calculated for us $34,055,227. Next, statement of cash flows. Operating cash flow relates to cash paid for interest. Interest payment and interest receipts are all operating cash flows. Back to the amortization table, cash paid for interest totally in 2018 is $32 million. So add a negative sign before $32 million because it is a net cash outflow. Investing cash flows relates to long-term cash we spent for purchasing long-term assets, investment securities. But here, the example, Myriad Solutions issued, they are the people who borrowed monies. They are not the people who lend out monies. So here, they didn't have investing cash flow. Since they borrow money, this is financing activity. So the cash they receive from issuing the bonds to 83,294,720 in 2018 is the financing cash inflow.